and uh, to bring you Bob Javid and Greg Epi. So Bob, a little bit back his background. He's a certified public accountant for over 20 years in the public accounting, specializing in audit, tax, and forensic accounting. He's a co-founder of Lopez and Javid, certified public accountants and consultant. He has built a reputation for delivering high-quality assurance and advisory services to engineering and construction firms across South Florida, but he also helps clients identify and implement effective tax saving strategies to enhance profitability and long-term financial health. Also with us is Greg Epi, coming as a UCF grad. He has joined his family's firm, Levante Wealth, has been around there for almost 13 years now. He holds Series 6, 65, and 215 licenses offering financial planning, insurance, and investment products. He likes to communicate. Greg and I go way back. We've worked together in the past as we talked about ABLE accounts, but he's going to kind of bring to us a holistic approach on when it talks about planning for family members and our loved ones for now and the future. And as I said, I'm the director of ABLE programs. So in case you don't know, ABLE accounts are tax advantaged savings and investment accounts specifically designed for the disability community. What's exciting, though, is we're 59 days away from the ABLE Age Adjustment Act, which will now bump those who are eligible, where currently you had to have a diagnosis with onset prior to 26. That's actually going up to 46, which is going to be able to expand this to about 1 million individuals, or about 6 million nationwide, 1 million veterans. Here in the Florida, that's going to double the amount of adults who will be eligible for ABLE accounts. But there's a ton of information to get to, and at this time, I'm going to go ahead and pass it over to Bob to kind of walk us through his presentation. Thank you, Bob, for being here.
Thank you for having me. Is my screen shared right now or not yet?
Not yet.
Not yet. Give me 1 second. Can everybody see that?
Perfect.
Fantastic. Give me 1 second.
And
Perfect.
while he's doing that, just some housekeeping in case you do have questions. We have a Q&A box. Feel free to drop your questions in there, and hopefully we'll have a little bit of time at the end to answer your questions.
All right, we ready to roll?
Yes.
Sounds good.
Fantastic.
Thanks.
Good afternoon, everybody. Today we're going to talk about how to help young adults with disabilities build real independence without accidentally losing SSI or Medicaid. I'm going to show you how income, family employment, trusts, and ABLE accounts can all work together safely and strategically. So to start, let me give you a quick roadmap of where we're headed today. We're going to start with SSI basics, how benefits and income limits actually work. Then we're going to move into family employment, tax-free fringe benefits, healthcare layering, and the key tools, special needs trusts, and ABLE accounts. Finally, we'll put it all together into one complete plan that keeps benefits intact while building long-term independence for your child. Let's begin with the foundation, understanding what SSI really is and how it works. SSI is going to provide monthly cash assistance for people with disabilities and limited income. The benefit's about $943 a month in 2025, and it automatically allows Medicaid coverage. There's an asset limit, which is very strict, about $2,000 for individuals and $3,000 for couples. Because of that, the key is structuring income and savings in approved ways and not avoiding work or growth. Now that we've covered what SSI is, let's look at how income affects it. SSI doesn't automatically disappear when a person starts working. It simply steps down gradually. Social Security first ignores $20 of unearned income, which is typically interest, dividends, capital gains, But if there isn't any passive income, this $20 gets rolled into an exclusion on wages, the exclusion of which is $65 of earned income. So basically, you've got the first $85, which is very nominal, is excluded from the step down for SSI benefits. After these two exclusions, the SSI benefit is reduced by 50% for basically every dollar earned. So for every $2 earned, there's a dollar reduction in SSI benefits. On the next slide, we're going to see how that works with a real life example. So taking an example where your child earns, 1585 a month, you would exclude $85 and you would have $1,500. Of this, half of which is 750, gets reduced off the monthly benefit of 943, which leaves only $193 in SSI payments. So, what we're taking away from this is, the more the child earns, the more the benefit gets reduced.
And do you cover also in here the income limits from the Medicaid side as well? I know that a lot of times with parents, the income for the SSI is important. If we lose it, it's a big deal, but not as big a deal as losing Medicaid. So do you have those details as well?
Yes, I think a later slide covers the Section 1619B,
Perfect.
and we'll definitely be getting to that. Okay, so now that we've talked about work, um, we see that the more a person earns, the benefits start to decrease. So what do we do about this? Even small amounts of work will lower your SSI check, and that can feel really discouraging. The goal here isn't to avoid work, but to manage hours and pay so that income stays below the limits set by SSI, which is about 1550 a month in 2025. As long as a person earns less than this, and that they're properly reporting this, benefits and Medicaid can remain intact. So how do we make work worth it without risking benefits? Family businesses are a great tool for this. Parents can hire their child legitimately, pay them a modest wage, and offer non-cash benefits like health insurance or education assistance, and several more tax-free fringe benefits. Proper payroll and documentation make SSI safe and also tax efficient. The child gains experience and purpose, while the family protects the child's eligibility. Let's talk now about how to ensure tax compliance for family businesses and talk about how that's done properly, because good intentions still need good documentation and paperwork. For legitimacy, if you form a business, you've got to apply for an EIN with the IRS, file a Form W-4 and I-9, which are basically employment eligibility forms and proof of U.S. citizenship or residency, and you also have to run real payroll. If both parents own the business, and this really only applies to like an unincorporated business or a partnership, wages paid to your child under age 18 are exempt from FICA tax, which represents a potential savings of 15.3% of wages. One things you have to do, you have to keep timesheets with brief descriptions of the work performed by your child, and documentation is everything when it comes to SSI and income tax compliance. Now that we've talked about hiring your child in the family business, let's look at how to keep everything clean for tax and SSA purposes. From a tax standpoint, wages you pay to your child are deductible business expenses, just like any other employee. You have to keep business and personal finances separate. Your business should have its own bank account, books and records, and separate payroll records as well. Depending on your entity type, you'll report the wages on your business return as a deduction, whether it's a Schedule C on an individual return, a Form 1065, which is a partnership return, or a corporate return, which is either an 1120 or an 1120S. Your child will also file a Form 1040, which will report their wages as well. For SSI, these wages count as earned income, but as long as they stay below the substantial gainful activity threshold, you can preserve eligibility. The last step is just as important as the work itself, making sure wages are reported correctly to Social Security each month, which we're going to cover next. Now that you've got wages properly documented for tax purposes, the next step is to make sure Social Security knows about them, because transparency is what keeps SSI and Medicaid secure. Wages should be reported to the Social Security Administration every month, ideally by the 6th of that month. You can use the SSI mobile app, a phone line, or visit a local Social Security office. Always keep copies of pay stubs and bank records. Those serve as your proof if SSA ever questions the amounts paid. Be sure to let SSA know right away if your child's pay hours or pay rate have changed. There are monthly reporting requirements to SSA to protect your child's eligibility.
Which I'll just chime in to say that we're talking really specifically about anybody that has a business and that has the opportunity to potentially hire their child in their business. If you don't have a business and that's not something that's a viable option for your situation, then some of these points are not going to be specific recommendations for your situation versus if you do have a business, some of the other stuff we're going to touch on will be directly for that. But that's where I just want to make sure that everyone understands that these rules are very specific to if you have a business that you could hire your child inside of.
Thank you, Craig. All right, so now we're going to look at, the regulatory environment around, work requirements as it relates to SSI. At the moment, SSI does not have any work activity requirement for eligibility. However, I've seen other federal programs like Medicaid and SNAP, which are starting to testing work and activity requirements in various states. Legislators are discussing expanding these requirements to SSI as well, but nothing has been finalized as of now. Best approach with this is simply to be prepared. You got to keep clear employment and income records so that if new reporting or participation rules do come into effect, you'll be ahead of it. The biggest takeaway is to build flexibility into your child's plan. Make sure it can handle a small amount of earnings or new documentation requirements without losing their stability. So this is just something to keep an eye on. It's nothing really to worry about because nothing's happened at the moment as of now. So now we're going to switch focus to Medicaid, because at the center of every benefits plan is Medicaid. Medicaid's what provides essential medical coverage to your child, but it doesn't cover all expenses. Things like dental, vision, there are even therapy caps can leave gaps in what your child needs versus what's covered. That's where health plans like employer coverage, if that's applicable to you, or supplemental plans will come in to fill those holes. We're going to touch on FSAs and HSAs in just a moment. So here's a listing of typical things that Medicaid doesn't cover, which FSAs or HSAs, or even ABLE accounts or a special needs trust can fill the gaps in, because some of these things can really add up in costs very quickly. So now we're going to discuss FSAs and HSAs a little bit to see how we can cover the gaps of what Medicaid doesn't cover. So flexible spending accounts and HSAs both let you set aside money tax-free for qualified medical costs. For FSAs, the key points are that they're employer-based, funded through payroll deductions, and when used for medical expenses, they don't count as income for SSI. The main limitation is that they're usually a use it or lose it each year, but funds restricted to medical use aren't counted as assets under SSI. The key point here is to anticipate what the need for out-of-pocket medical expenses will be for the year and fund the FSA accordingly. HSAs work a little different. They're typically linked to high deductible health plans and can build in value over time. Contributions, earnings, and qualified withdrawals are tax-free. Because HSA balances can be accessed for non-medical use, the Social Security Administration may treat them as accountable resources, which that's a really big, pitfall with using these HSAs. The strategy here is to keep balances as low as possible and make sure that withdrawals are used only for necessary medical expenses. That way, you reduce out-of-pocket costs without impacting your SSI. So as Craig mentioned earlier, we're going to talk just a little bit about Medicaid because if your child does lose SSI because they're making money, there's this Section 1619B, which is there to protect their Medicaid benefits. So Section 1619B allows Medicaid coverage to continue even if SSI payments stop. As long as your child meets the disability criteria and their annual earnings stay below around $40,000. This provision makes it possible to explore higher earnings without fear of losing health care. In other words, Section 1619B is a safety net that lets families say yes to work opportunity while keeping critical coverage in place. Now that we've seen how Medicaid can continue even when earnings rise, the next step is coordination, pulling all the pieces together into a complete plan. So our goal is to keep Medicaid as the foundation since it provides the most comprehensive base coverage. Then, when available, layer in employer health coverage. Those plans are considered deductible and don't count as income or assets for SSI purposes. Next, two great tools we can use are a special needs trust or enable account to pay for gaps that Medicaid or a health insurance plan won't necessarily cover. Things like dental expenses, travel, medical related travel, or even like a laptop or cell phones, etc., adaptive technology. Lastly, we want to maintain Medicaid access through Section 1619B, even if SSI cash payments pause. The big picture is integration. Each piece supports the other so that your child can work, save, and stay insured without breaking eligibility.
When you say maintain section 116 or 1619, what does that really mean?
So if the child is working and let's say earns 25, there's a $40,000 wage cap where Section 1619B becomes, basically irrelevant, like it's not applicable anymore. They can't keep their Medicaid. So if the child's working and making more money, we want to make sure that they're not going to hit over $40,000 because if they do that, they're going to lose their Medicaid coverage.
So I saw one of the, not to interrupt, but I saw one of the questions that came in actually was asking about Medicaid and those income limits. So to the person that had asked the question, there's about a $40,000 income limit on that situation. Now that's not asset based. The assets also matter to the points before. You can't have more than $2,000 in assets, but those are going to be the things that disqualify that kind of situation.
And I'm also assuming now that's just straight up like the healthcare Medicaid, right? So for example, the Medicaid waivers, whether that be the iBudget waiver through APD, the long-term
Medicaid
care
waiver
waiver.
is not income based. Okay. So that one operates separately. So all the benefits Bob's going over here are separate from Medicaid waiver, right?
Correct. There's different rules for those.
Correct. And so you want to understand the rules, but to John's point, you're going to first see disqualifications as far as all of these things we're talking about with SSI and with Medicaid, not your Medicaid waiver, first based off of these types of incomes.
All right. Now we're going to discuss special needs trusts, which are another very important tool in planning for your child's financial security. Um, Special needs trusts are designed to hold assets for the benefit of a disabled person without jeopardizing their SSI eligibility. Assets inside the trust are not counted for SSI resource limits, meaning there's effectively no limit on how much can go into these special needs trusts. There's two types of trusts. There's a first party trust and a third party trust. The main difference between these two that I'd like to point out is that with a first party trust, there is a Medicaid payback after the person's death, whereas with a third party trust, there is no Medicaid payback, which makes it kind of more preferred type of trust to go with.
Well, I'll add there that the first party trust is generally going to be the individual's income, right? So this is where the ABLE account is going to come in big time because if they're making their first incomes, you can use that as a place to put their income versus if not, and we're trying to avoid that $2,000 rule, you would then look to a first party trust, right? The more commonplace we see these used even are with lawsuits, right? Someone want an accident happen and they want a settlement, and those dollars are going to get forced into a first party trust, where the third party trust is going to be anybody else's money. Mom and dad can set it up, grandparents can put money into it, brother and sister can put money into it. It's anybody else's money. The keys are still what Bob is saying, right? The no payback is the big reason why we would want the third party primarily, anyways. And we'll touch a little bit of that in the second part of our presentation here. But very key points here that Bob is mentioning that you want to be aware of as you look at your larger planning.
Exactly. And the other point I wanted to make with these special needs trusts is while they can be used to pay like medical expenses and certain necessary expenses, they're more of an asset and security building tool, whereas compared to an able account is more of like a savings account for day-to-day expenses, which we're about to transition into talking about able accounts next. So, as I just mentioned, able accounts are for everyday expenses. They let individuals with disabilities save money without losing their SSI eligibility. Um, Earlier, it was mentioned that starting next year, the qualification is the age for qualification moves to age 46 in 2026. Anyone can contribute to these ABLE accounts, whether it be parents, relatives, or the disabled child themselves. There's a limit of the amount of contributions into these accounts, and that's $18,000 a year.
So
And
yeah, so just get an update. So that's 19,000 actually for this year. And then more if they're working, they can contribute above that. But next
yeah,
year it's
there's another
actually
14, I believe.
yeah. Next year it's actually going up to 20,000 could put on this, and I think it's 16,000 or so for individuals
Well,
employed.
But I'll say these accounts I have seen as a financial advisor, I have seen larger growth in these contribution limits than almost any other account that we see where limits, like retirement contributions and things like that creep up over time. This one has had a very nice pace, so it's a good thing to see.
Absolutely. One of the key points we need to drive home here is that we want to keep these able accounts at or below 100,000 if possible. I mean, you can contribute more, but after it goes over 100,000, SSI counts the excess as resources, which could jeopardize eligibility for receiving that benefit.
Where
And
those trusts and everything else you were mentioning come into play.
yeah, and the trust is unlimited, which is great, which is why it's a great, wealth transfer tool. So some of the expenses that the able accounts can pay for are housing, healthcare, transportation, or even like I mentioned previously, like computers, cell phones, etc. So basically, it's a flexible, family-supported way to save for independence while staying fully protected for SSI.
And I'll plug John and his team here. Their website is very informational. If you go to the Able website, I literally, in the middle of my planning meetings with clients, I will pull up that website to show, go to qualified expenses and look at some of the breakdowns of some of this information. It is right there on the website.
So now we're going to compare, Able versus Trust, which we've, kind of previously touched on. But, in summary, Able accounts are simple and low costs. They're great for day-to-day spending and small savings. They have the limits that we previously mentioned, the $19,000 per year and the $100,000, cap if you don't want to run into trouble with SSI. The special needs trusts, they do require a little bit more compliance. They're a little more complex. You have attorney costs, but on the flip side, they have that availability to, contribute unlimited funds to them. And in the third party special needs trust, there is no Medicaid payback at death. And the takeaway from this is that using both of these vehicles is really your best strategy to provide for day-to-day expenses and also build up security for your child. So now let's put this all together. We've covered a lot of information here, and now let's see how it fits into a simple structure that you as the parents can actually see. First, I think you need to use a special needs trust to hold larger assets, inheritances, gifts, and like Craig said, settlements, so that they're fully protected under SSI. Second, the ABLE accounts will be used for monthly or everyday expenses, things like we previously mentioned, rent, groceries, technology. And there's a key caveat from this with the ABLE accounts that the payments have to be made from the ABLE account directly to the vendor. The money cannot flow from the ABLE account to your child and then to a vendor. That will trigger, an issue with benefits and potentially reduce them. And lastly, adding health plans and having the trust assist with paying this will supplement Medicaid, will supplement the expenses that Medicaid doesn't cover, such as the dental, vision, or caps on therapy, and even some type of like alternative treatments that are typically not covered. So the end game here is coordinating all these different strategies, wages, benefits, a trust account, and able. They all work together to protect eligibility and expand your child's independence. On this slide, we have, some resources. I made some modifications to the presentation, which I'm not sure everybody has. I'll make sure that this is circulated. But these are some resources you can use to get more information. I think it would be very useful to look at this. And here's a summary of all the points we talked about. It's all a little redundant, so I'm not going to keep you guys with that. And I just want to thank everybody for their time today. I hope what I presented gave you something of use. And if you have any questions, my email address is below.
Awesome. Well, thank you, Bob, so much. And hopefully you can stick around. If you can't, we understand. I know you have a pretty busy schedule today. So with that, we're going to turn over to Craig now. Craig he's going to bring it kind of home to us, kind of hear all this information that we just heard. Think about, I know a lot of people's wheels are probably spinning with all this information. And so Greg's going to kind of hopefully be the glue to sticks it all together and kind of give us that holistic approach to planning when it comes to special needs and the different tools out there. So,
Yep.
Craig, I'm going to turn it back over to you.
No, absolutely. We're going to cover some of what Bob touched on. We're going to take it from a different perspective. I want to take the pieces that he gave us, which were important, and I want to make sure that it all comes together, like John was saying, John was saying. And the big key here that I want to make sure we address is like my presentation, like the topic says, special needs planning and retirement. But then in relation to what we had talked about in the beginning, which was what's tax efficient, and what are the ways that we can do things that are going to really make a difference for us, right? So if I'm spending a lot of money, how do I reduce expenses, right? If I'm not saving enough, how do I find a way to save more? Well, both of those are two sides of the same coin, right? If I spend less, I'll probably save more inherently, right? So we're going to try to bring all of this stuff home, and I'll skip over the things that we've already completely touched on. But my background, like John had said, is in special needs planning. I actually work with my father, who has a even longer career in this topic. He's been doing it for about 33 years now. And so he's been doing special needs planning since special needs planning became a legal form of planning. Meaning in 1993, they actually added the special needs language to the irrevocable trusts that these ultimately end up inside of, as far as how do you protect the benefits and leave the dollars. Because before that, all of the planning had to be done in a first party trust, right? Meaning all of the planning had to be left in a place where the government gets to take it back at the end of the day with its Medicaid reimbursement, because the benefits are pretty extensive. So normally the payback is more than whatever's in the trust, just as a historical, frame of reference. We've been doing this stuff for 30 years, like I said, so we have a lot of clients that got us into this space. One of the clients was who you see pictured here. And so we started working with this family, and 30 years later, we've been spending our time in special needs doing presentations. John and I actually met at another special needs presentation, so we always are out there trying to get this information out there. And we've touched on some of this stuff. Like I said, we've touched on ABLE accounts. We touched on the special needs trust a little bit. I do want to come at it from a different approach, and talk about comprehensive thought process, right? Coming from the top down, how we make sure that our lives are put together and so are our child's, right? So first, you have to make sure your life is put together, retirement, legal planning, all of those things, because when something happens, when it's needed, it's going to put pressure on the rest of the situation, whether we like it or not, unless we have one of those extremely fortunate situations where there is enough assets to truly separate those concerns, right? But that's not normally the case. That's very far and few between for our clients. So generally speaking, I want to make sure that people really have peace of mind and comfort as they look through all of these things, right? So we'll jump into some of those tax efficiencies and things as well, but I want to make sure everyone also has a good legal formation to their structure. And part of that legal formation are the basics, right? Durable power of attorney, healthcare surrogate, and a living will, but also a letter of intent, right? So if our child is has a job, did a college program, but still needs some type of assistance, we want to know that the legal stuff is there, but the legal does not put together all of the personal information, right? So for us, we really like our clients to work to put together what we call a letter of intent, right? And ours, the one that we give our clients, is super detailed, where it's going to have daily schedules and doctor's information, account information about, what type of assets are out there, all sorts of stuff. But it's important that you do think about those pieces separately as you go through your planning. The finances matter, all these other topics matter, but we want to know that there's that true comprehensive plan, okay? And I will try to answer questions as I go. If I don't get to it, like John said, I will definitely make sure to answer them in the end. I see the first question here. Do families need to advocate for this amount of increase? Someone's asking a question about the limitations. We were talking about the $2,000 limit, and yeah, it's extremely limiting, and we do advocate to push for those. We can always use more advocates. So if anybody has connections or wants to push, up at City Hall, that's, or up at Congress, that's definitely something we recommend. But unfortunately, that is the scope that we're underneath. And that's why this planning exists. That's why we want to do this planning, to make sure that it ultimately doesn't limit our ability to actually make things happen. Okay. So we did touch on trust before, but I want to touch on a couple of different points with the trust. The trust that Bob was talking about, first and third party, first, they're going to start as a revocable trust. That third party trust while you're alive is going to be changeable, right? The moment we pass, we're going to have it become unchangeable. If we're married, maybe we're going to have it at the second death, it becomes irrevocable. But that's where we're really going to lock our rules into play. So it's one thing that we want to first get these things set up and structured. It's another thing to know that we can still edit and change these things as our life evolves, our kids get older and their life needs change. And so our decisions inside what we're going to do for them change. That can all be changed until you pass, right? So that's a very big point. But then the bigger points for me with the trust, and we talked about this a little bit, but not in this relationship, right? We're worried about saving dollars, right? So we're talking about, oh, what if I use an HSA or an FSA? I'm going to save money up front, right? Meaning I'm going to be able to have the tax efficiency of using that account, and it's going to save me the difference in my taxes. Meaning if I put in $1,000 into that account and I spend $1,000 from an HSA account, and my tax rate was, let's say, 30%, I saved 30%. I saved $300. I didn't save the 1,000. It was still my $1,000, but I did save the 300 in my taxes, right? The trust that we're setting up are taxed at the highest rate of the day. So depending on what rate of tax you're used to now, doesn't matter. Will be very different for that trust. That trust is going to see the tax at the highest rate of the day. So depending on what state you're in, it could vary. For Florida, we'll talk about, we're generally going to see the highest rate be around about 35%. But certainly go to like New York or California, you could be talking about 50% or more in taxes that you're going to see from that trust, right? So we want to talk about not just how are we tax efficient while we're alive, but what happens when we're not here, and what assets do we leave to our child, and how efficient are those assets? Because I, in general form, when I talk to parents, don't tend to see that they care as much about the assets as they do about the income. Meaning, if we could paint a perfect world where I said, here's the income that you get, well, then we don't need to worry about what assets are in the trust. But realistically, we know that's not the case, right? And so we need to look at not only how are we being efficient with our dollars while we're alive, doing things like the ABLE account, the HSA or FSA, funding retirement has the same tax deduction, right? If we put money into a pre-tax retirement account, so not Roth, but any type of pre-tax 401k, IRA, 403b, whatever it might be, it's going to reduce our taxes, right? So, but those are not things we're going to be looking at inside the trust. Once we get to the trust, here's the assets going in the trust, and they're likely going to see the highest rate of the day. There are some ways to potentially avoid taxes with very strategic income structures. And that's something that would be, for more individual consultations, which before we leave, I can even give my link for consultation, which I'll even take a pause to just say it now. But between myself and Bob, if you're looking to have a further conversation with either of us, we're both happy to have a conversation and answer more questions. And so I'll provide my link, and then you'll have absolutely Bob's contact info to feel free to reach out to him as well, to talk about this in more detail. But ultimately, the tax issues of the trust we want to look at, it's not going to be your upfront first concern. First concern is getting things organized for today. But ultimately, we want to be aware of that tax issue because it is going to be a major component in, did I leave enough, right? $1,000,000 sounds like a lot of money until 35 or 40% of it is taken to taxes, right? So that's one of them. The next is going to be operations of the trust, right? Call it administration. If you have family doing everything for you, you could talk about reducing this cost a lot. But realistically, that's not normally the case, at least for 100% of things. And this is where you talk about who's overseeing the picture, right? We have a trustee over the finances and a guardian over the person. So we'll talk about guardianship in a second, but ultimately, I want to know that these trust operations are covered. There are companies called corporate trustees that are ultimately connected to banks, but corporate banks and investment companies, but they are called corporate trustees, and they won't charge you anything to have their name listed as a backup. So as a band-aid, for sure, we want to list one as a backup. But if your, sibling isn't there, if the aunt or uncle or whoever is that person that was going to be taking care of the situation is, God forbid, not there, we want to know that those things are covered and that the trust can afford the cost of what that looks like. Okay. And then to my point before, funding options, right? What assets are going in? We definitely want to look at some income strategies to that point, to my point before, as well as we want to look at, do we have 3 kids that we're leaving things to, and what assets are we leaving where? Because certainly some might work a little more efficiently. So that's where we want to make sure to address that. Now, guardianship has not been touched on at all yet, but I do want to do a quick plug on guardianship. If your child's already over 18, you should be looking at it. The healthcare surrogate and the durable power of attorney that we talked about in the beginning does not give you express authority over. That gives you the ability to take care of someone if they're incapacitated. But if your child is not incapacitated, then when they're 18, they're an adult and they can make all their own decisions. And you absolutely should be at least understanding what is guardianship. You have 3 kinds of guardianship. You'll see them here: plenary, limited, and advocacy. Plenary and limited are the full forms of guardianship. Those are going to require an incapacitation hearing with 2 attorneys, and it can be quite expensive, north of $10,000. For most of our clients, we recommend advocacy where it fits. Advocacy is much more affordable. It will only cost you a few $1,000s with an attorney, and it only takes 1 attorney, and it's not going to take away all their rights. The full forms of guardianship can take away their right to vote, their right to marry, right to drive, their literal rights. Advocacy is just going to give you authority back over those, just like when you were an adult, or when they were a child and you were their guardian, sorry. So that's where you'll talk about life, health, and financial decisions. Those are the 3 main categories. So life decisions, where are they living? Health decisions, we go to the hospital, going to the doctor, who's the boss and who's listening to who. And financial decisions. Financial decisions, this one is big for me because it protects your child against exposure. Meaning, if someone sent them a credit card offer in the mail, or tries to take advantage of them, there are ways that this protects them from those debts and those issues. Best example I have is a client whose Apple account got unlocked, and their daughter spent $7,000 in one day, and their advocacy was sent, a copy was sent in, and Apple undid the charges right away. Right. So definitely want to look at that. And this stuff opens up 6 months before they turn 18. So you can start to work on it a little early. That way you're there for 18. If it's after 18, it's okay. Right. It's just better to have it at 18. But if they're 25 and things have been fine, you want to get it for those future protections. But if you've made it till now, then things are okay. We touched on the Able account, so I'm going to skip over a bunch of the Able account stuff because we really already touched this. I will make one note for John. In my presentation, it was right there. You'll see I had the 19,000 limit, so I had it right. And this is where John was touching on, how do we help parents with taxes and understanding their situation? There are things that you can deduct from your taxes, and that's from an expense standpoint or from a contribution standpoint. So best is from contribution standpoint. Able accounts, retirement accounts, right? Things that we can then go use later. That's awesome. But we also have the deduction side, and that's where you will look at medical expenses. And the question is how big are your medical expenses, right? Because that's where the tax laws are going to come into play on what can you deduct. And if we're under those limits, the Able account, the HSA, the FSA are great ways to get that deduction up front without having to qualify in your taxes on the back end, right? Versus if we're a business owner, so we talked about business owners in Bob's presentation, Business owners have a lot of tax deductions. So you can make your child an employee in the business and talk about, maximizing some things for your employee, for your child, like we were. But it's also about the deductions that they receive. And when you're not a business owner, you don't get all those deductions. And so that's where you really want to push into things like these to try to find some real efficiency where you can. Okay. Well, and there's one other thing I can touch there. Functions like a 529, right? So able accounts are essentially an expansion of 529 in the sense that they work extremely identical, except the 529 was more restrictive. So you're better with an able account than a 529, in my opinion. We did touch on this a little bit, so I'll just touch on it for a second. I can see mine does need to be updated. It's 943 now, so this one was from last year. But these benefits we want to protect, right?
Even higher, Craig. So next year it's actually going up to 994.
994 for 2026.
Yeah, which is
Awesome.
crazy because the asset limit's still 2,000. So there's
Yeah,
going to be
exactly,
a lot
right?
of individuals that
This
are
is
going to
the-
be, needing an able account and be in a spin down situation. So, that number needs to be adjusted for sure.
The extreme parity of the planning that we have to do here in the way that these numbers work. And this is, for me, the only thing we can say as a saving grace is thank God for planning ahead of time. Meaning that if you do take the time to plan ahead of time, there are ways to kind of work around these variables. So they're very much not really affecting you. But that's where absolutely I care more about the Medicare and Medicaid. And let's even take a step further and talk about you have SSI Medicaid and then you have SSDI Medicare, right? When you retire yourself, your child is going to qualify for SSDI based on your retirement, right? Because they are disabled before age 26, Social Security Blue Book definition. You are going to have them qualify for even additional benefits. So the 996 that we're talking about will be even higher. I have clients that get 14, 15, 1600 a month based off their parents' Social Security, right? That could also come into play if your child is working, right? Eventually they're going to qualify for their own benefits that will stack on, right? Separate qualifications and disqualifications, right? So we have to understand those separately. And that's where that last one that we had touched on before, med waiver, not income based, right? So we do want to understand that benefit because it is an imperative benefit in many, many cases, especially as we get older, because it's covering all of those things that we were kind of talking about before in Bob's presentation that are not covered, right? Therapy costs, program costs, if your child has a day program or a summer camp or, different school costs, things that can be covered that are not going to be ever covered by a Medicare, Medicaid type of benefit, and certainly can't be covered by your 900 to $1,000 of income because that's, rent alone could eat that up. I have clients that pay more than that in rent for their child. So they just use the income as a supplement to the rent. And then, they just keep paying on top of it. Right. So we want to understand these benefits. And then of course we want to protect them. And that's where that special needs trust comes in. That's where able accounts come in. And Bob made a really good point before, which is lower cost able account. Meaning if we have a situation where we're never going to leave more than, 50-ish grand, and I say 50 because the able accounts will grow, right? So if we put money in and we don't touch it, it's going to grow. I got to worry about that $100,000 number, right? So that's where you want to be careful with that number, but the trust can always put money in the able account, right? The trust can literally send money to the able account, to Bob's point before anyone can put money in, right? So that's where you can always make sure that there's the right mousetrap, the right flow of funds to happen there, and really maximize the benefit of the able account. Because again, we're getting a lot of tax efficiency out of that able account. We want to use it. When I have a client that can put in lots of dollars, I'm going to have them get close to the 100. Generally, I get them to about 80 grand. And then I'm like, all right, let's start spending a little bit and, just making sure you don't get over to 100. But I want them to get close because I want them to maximize. Right. And we touched on this before. Like I said, go to the website. There's lots of things you can spend from. It's very easy in that sense. And John and his team are great for those kinds of questions. Now, to the point of the trust, we got to talk about retirement and the assets, not only for titling, which is what this is about, right? Review your beneficiaries and make sure everything is titled properly. Because if it doesn't go to the trust and it's not already in the ABLE account, the courts are going to mandate that it goes to your child's name, right? They're going to essentially mandate a disqualification of benefits, right? You leave an account for over $2,000 and it goes to your child, it's a disqualification, right? So review all of those things, and I'll even throw in there, right, like a final paycheck, collectibles, things that we don't think about that could have value that absolutely that could cause an issue. So the final paycheck, I think, is a great example of it because it's just things that people do not think about. All right. And then we have to make sure this planning comes together. So let's talk about the pieces and the retirement side of it a bit, right? For me as a special needs financial planner, I care about all the pieces. The guardianship that we talked about, some of the accounting, types of things that we touched on as far as, ways to avoid, not avoid, but to reduce taxes, the legal aspect of things, trust, guardianship, the government benefits. The last piece of this puzzle you're going to see says housing and services. And that's where I really like to just talk about the rest of life, right? You plan out all this legal stuff, you plan out all these benefits, but your child lives in your home. And are they going to always live in that home? Are they going to have, care in the home? Are we going to go to a group home or maybe a shared home situation, which is the most common that I see, where it's, a client will have them live with a couple of roommates and they'll all pitch in to share expenses. But we need to make sure that all these costs can be covered, right? And so Bob was talking about this a little bit. This is just a little bit of a graphic to help separate it in your minds. What's the benefits you're getting on the left? And what does it pay for? And what does the trust or your additional dollars really come in to cover on the right side? And you'll notice things on the left probably aren't even fully covered by their benefits, right? Room and board, okay. Maybe the care and supervision a little bit, or maybe you have like an employee, maybe you're doing employment or something through, vocational rehab or through, an ARC type program. But there's a lot of chances that, even just in basic personal needs, they're not getting enough covered by their dollars. So that's where you're going to see a lot fall on the other side. And we have to look at your retirement to know, okay, when do you retire and how much do you guys live off of? What does these expenses cost for everyone in the family today? And what is already going to be covered? What's Social Security and your income view for retirement, and how will all of this be covered? And is it covered well enough that it's not going to put a strain on assets? Because most people tend to see their assets decline over time as they get older. Not that they're going to completely run out of money, but they're absolutely falling down the hill versus seeing the hill continue to climb as they're retired. And when we have the need to fund a special needs trust at the end of that, that's where that concern really comes in for me, in knowing, hey, I want to know that there's a game plan that actually makes sure that I don't have to worry about the longer I live. I'm not worried about the special needs trust getting the funding that it needs, right? Now, life insurance is a great tool to fund that trust if we don't have enough dollars there, but that's where we want to, do that planning, right? So at the end of the day, it's a lot of information to take in, but we want you to take the time to understand it. If you want to come talk to me or Bob, like I said, please reach out. We do go through a very detailed process. Accounting is a little different with Bob. That's going to be more about going through the structures, creating some of those structures, and handling your accounting, your actual tax return, to make sure things are done right, make sure your reports are handled properly. For me, it's more about planning, coming together, answering the questions, filling in the gaps. We provide software to do all of this, so we try to make it a very comprehensive, hands-on experience. But if you are interested in coming to talk to us, please, you just let me know and happy to go over how our process works. And I will go ahead and put my link in the chat for everybody. If you need to reach out to me, I'm sure John and team will probably send out my email as well. But this is my link to book a meeting on my calendar. So if you guys do want to book directly with me, feel free to use this link, and I'm just going to put it in the chat for everybody. And that is all I've got for you.
Awesome, Craig. Thank you so much. That was a lot. So go ahead and leave that screen up there so people can capture it. Because I think our chat is just for internal hosts and
Instead of,
panelists.
host and
So
analyst, I see. Okay. Well,
yeah,
I'll make sure that my link does get out to you guys. But yeah, this is my contact info, so feel free to reach me at Craig@levantewealth.com.
I wonder if we could do a. Okay, I was just wondering if we could do a whiteboard. I could post it on there, but no, that's perfect. Definitely check out. There's a ton of information. Craig, I can't thank you and Bob enough for taking some time of your afternoon and giving us this wealth of information. It is complex. There's a lot of tools out there. There's a lot of information, and it takes a lot of time to do it right. So. We just wanted to thank everybody once again. This recording will be placed hopefully on our YouTube channel. And just remember, this was all for information and education. Your unique situation is unique for you. So we always encourage people to talk to a professional, consultant, legal, tax advice to find out how to get something accomplished for your specific needs. But with that, I wish everybody the best of afternoon, and thank you again.
Have a good one.
Bye.